Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamental analyzer software tool, a.k.a. Mr. Valuation. In my last video on consumer discretionary stocks, I showed a portfolio that had 15 stocks in it, and I inadvertently left off 4. So this is part B, where I'm going to add those 4. And kind of interestingly, 3 of those 4 that I left off are probably 3 of the favorites of all the groups that I showed you that for me personally. So I'm going to talk a little more about them being good investments as well as being good undervalued stocks. So let's go ahead and get into the fast graphs and let's look at the portfolio I created first of all, and then we'll look at the 4 stocks that I left out. So here we have the consumer discretionary stocks that were in fair value. You could see that the PE ratios range from 6.92 up to about 16.43, which is on the high side of what I like as an investor. I like to see PEs around 15, but I really like to see earnings yields above 6.5%. The earnings yield is what it's all about. The PE is just a measurement. And I think people get really confused with PEs and things. It's all about earnings yield. What earnings yield tells you is if you owned the whole company and you were able to get 100% of the profits the company generated or earnings that the company generated, what would be your yield on your investment? And that's what earnings yield really is. So now in the first video, and actually all the videos I've done recently, I've also talked about the level of the stock market. Now, this is a graph of the SPDR S&P 500 ETF Trust. And as you can see, the S&P 500 has traded between a 15 and 18 or 19 multiple. Well, I'm going to call it between 15 and 20, because even though there's a specific number here, you need to think of this as a valuation reference. And then all of a sudden, coming out of COVID, we've seen these 2 periods where first one ended in 2022 temporarily, and then here we are back in 2024, where the market is trading at a significantly higher valuation than has been historically normal. Now, the market is also growing a little faster than normal, but the point I want to get across here is we're not looking at a real inexpensive market. What this really is measuring more than anything is the amount of risk. So anyone buying an S&P 500 ETF or mutual fund today is buying it at a very high price. So the first rule of investing is buy low to sell high. You don't buy high expecting to sell higher without recognizing at least that you're taking a great deal of risk. Now, going into the 4 companies I left out in the last video, I left out Bloomin Brands, a.k.a. Outback Steakhouse was what they were known for, Dick's Sporting Goods, Century Communities, bills themselves as the most respected home builder in America, and then Autoliv, which makes a lot of safety type equipment for the automobile industry. Now, these are very interesting companies. If you look at them from a valuation point of view, first of all, they're all in consumer discretionary. 2 of them, Century Community and Bloomin Brands, have lower than investment grade credit ratings. So I do want to point that out, all right, before we get into it. Now, I'll talk about that a little more as I go through each company. But the valuations here are quite attractive, in my opinion. And the dividend yields are quite attractive on Bloomin Brands and quite attractive on Autoliv. The home building is more of a growth sector. It has the lowest dividend yield. And then Dick's Sporting Goods has actually increased in value quite a bit in recent times, over the last year or so, and it therefore has a lower dividend yield. So let's go ahead and look at these one at a time. Let's start with Bloomin Brands here, a.k.a. Outback Steakhouse. Now, obviously during COVID, like a lot of restaurants, the company was not able to open their doors, especially when the ones were in the malls. And of course, we saw this huge drop in earnings. We saw an elimination of the dividend, and we also saw this huge drop in the stock price. But then we saw this very swift recovery as everybody started coming out of COVID. Then we had a couple of years here of earnings. I'm going to call erraticism. We had a down year ending in December of 22, followed by an up year. The stock price kind of just reacted to that kind of normally. And then we had this big drop in 2023, and that caused the stock price to drop significantly. Now, the company has restated a dividend. They paid 56 cents in 2022, 96 cents in 2023, and are expected to pay that same amount this year. But because the price has gotten so low, if I put the dividend yield overlay here, I want you to notice that the dividend yield is the highest that it's been at obviously the time when the stock price is the lowest it's been. We currently have a 7.1% dividend yield. We're only paying 7 times earnings to buy the stock, and the earnings yield is a really strong 14.45%. Now, earnings growth over this time frame hasn't been spectacular. The fair value ratio of 15, though, is warranted based on a 5% growth rate, but the normal PE has only been just slightly under 14. The company only has a market cap of $1.14 billion. Again, it's double B minus rated and does have a lot of debt. The real allure here would be the low valuation and the high dividend yield. So if I go into forecasting and look at Bloomin Brands, I want to point out that numbers don't always work. That's why I think FastGraphs is such an incredible tool, because if you look at the perspective of the portfolio here and look at Bloomin Brands, estimated earnings growth is under 2%. Okay, so if you were just looking at that number, you would think this isn't really an opportunity. But let's look at why it's only 1.81%. It's only 1.81% because we have this down year here. We're expecting a flat year next year, okay, and then we expect 11.75% going forward. So analysts are believing that the company is going to come out of this, and there are 12 analysts giving us 24 and 25 numbers, but it drops off to 8. And the analyst estimates have been dropping on the company. I also want to point out, these are all things you should be looking at. The analyst scorecard is pretty attractive. The majority of the time, they either meet or beat analyst estimates. They have missed, though, 18% of the time on the 1 year with a 10% margin of error, and 10% on the 2 year with a 20% margin of error. So there's at least at this point, without further due diligence, a reasonable chance. But here's what I want to point out. This low growth rate, the formula that FastGraph uses to calculate fair value gives it a fair value multiple of about 12.13 times earnings. Okay, that's a very low multiple. If it were to achieve that multiple on these level of earnings from today's stock price, we'd be looking at a 62% gain by the end of 2025 and an annualized rate of return of 38.5% by the end of 2026. So there is an opportunity here based on valuation. If we went to the normal multiple of only under 10 times earnings, we'll call it 10 times earnings, and we still have a 36% annualized rate of return expectation if it made these earnings and if the market traded those earnings at 9.8 times earnings. And then if you went out all the way to 2026, you'd still be averaging 26% annual. So the point I'm getting at is this stock looks attractive here from a valuation standpoint, which means that the risk is relatively low to buy it at this low valuation. Historically, it's had a little better valuation than that if we look back here at where it traded at either between 13 and 15 times earnings and so on. But again, this is a speculative opportunity that could generate very high returns for the next couple of years based on its valuation and its high dividend yield. And again, the dividend yield is only high because the price is so low, and they're expected to not grow their dividend this year. The next stock on the list is Century Communities. Now, it has the lowest dividend yield. They're not even giving any forecasts for dividends going into 24, 25, and 26. And a lot of that has to do with the fact the company really has never paid out much in the way of dividends anyway. Now, we had this great growth surge here coming out of COVID, and then the stock never reacted to that. But this stock is another one. I call this a blue line stock. It tends to trade at 8 times earnings. Now, FastGraphs endeavors to give you valuation parameters. This company has grown at 25% a year, okay, 24%. I'm going to knock 1 year off of the time frame here, and I want you to point out here we got 20% growth. Okay, the stock was trading right at its PE ratio, its normal PE ratio of 7.70, where its normal was 7.57. If I calculate performance going out to currently for this 19% grower, I get 23% annualized rate of return, and with dividends, I get 23.9, almost 24. And the point is that correlates to the growth of the company, even though it's always commanded this low valuation. So when I'm going and looking at forecasting here, the company is expected to grow very fast. This would normally be a P equals growth rate valuation, or a multiple of 15.24, which would make this look very attractive here with rates of return of almost 100% by the end of next year and going up here into 50%. Now, if you don't know this company, I just always want to point out, you can always go to FastGraph's external links and go right into the company's website, and you can see where the company does business. They're doing business virtually all over the United States, the eastern. They have California, Alabama, Florida, Washington, Utah. So they build all over the United States, I guess you would say. And they pride themselves in saying that they're one of the most respected home builders in the country. Okay, so it's a home building stock, and there's some implicit risk there. But if I'm looking at forecasting and looking at the normal multiple, again, this is a blue line stock, the last 5-year normal multiple has only been 6. That doesn't make it look very attractive, but I don't believe that that is a rational multiple. I would like to go more to what I saw on the historical graph, which is about a 7.5 or 8 multiple, which is still extremely low. I want to point that out. So if I go into the normal multiple here and I use the drop down and ignore the last 5 years, and I use the drop down and I come up with a 7.57 multiple, which is relatively normal, then this stock does give us a reasonable chance to make a decent rate of return going forward. But the point I'm getting at is I don't want to use the 15 multiple, which is what its growth rate would suggest, because that to me would be denying what history has shown us. And history has shown us that this is a low multiple stock. So anyway, that's Century Communities. The next stock on the list here is Dick's. Now, I had some interesting experiences with Dick's. I bought Dick's years ago back in here in my portfolios, and actually people fired me. They were saying Amazon was going to run them out of business and so on. But Dick's did actually pretty well going through COVID, because a lot of their buildings are freestanding, a lot of their products. They grew earnings dramatically. The stock price really reacted. They paid a special dividend of $6 or $7. I'd have to go look in 2022. They have a January fiscal year. And then the stock is now trading at about a 16 multiple. By the way, it has a 2.21% dividend yield, triple B rated, and 53% debt. All right. So if I go look at this from what would the future look like, a 7% growth, a 15 multiple would give us a nice double-digit rate of return. Using the normal multiple of around 11, it wouldn't look so hot. And my point is, when I'm doing these kind of things, I'm evaluating what is normal. And normal has been recently in the 12 and 13 range. Now, in a 13 multiple, the stock looks a little better. But my point is, FastGraphs isn't dictating this to you. It's allowing you to evaluate it based on what you've seen historically, based on what future expectations are, and based on what the company may be capable of delivering. It does offer a 2.21% dividend yield and a reasonable amount of debt at 53% of capital. All right, so the last on the list here is going to be Autoliv. All right, now Autoliv, as I mentioned, is a specialty. Again, I'll go into the corporate website if you're not familiar with them. They're safety solutions, okay? They do things like airbags, seat belts, steering wheels, inflators, textiles, commercial vehicle solutions, etc. So you can spend some time learning about the company. What I like about this stock is it is triple B rated. It only has under 37% debt to capital. It's a cyclical, clearly, okay, but it's coming out of a very strong cyclical or cycle right now. And the analysts are very excited about this company, and they're looking for it to grow at over 20% a year. And if you use the P equals growth rate, this would be an incredible investment opportunity going for the next couple of years. The rate of return would be staggering. Now, you can look at things like Morningstar and go through other research, and I suggest all of you do your own research and due diligence. Morningstar gives it 4 stars, says it's worth about $119 a share. Now, looking at FastGraphs, if I use the normal multiple of only 16 times earnings and put it up here, that would be 134 by year end. It would be about 135 looking at the last quarter's numbers. So it's somewhere up in here. Morningstar's number put us somewhere down here. There's 108 to 124, and we put us between these two lines. So Morningstar, I think, the number is conservative. I think FastGraphs at only a 16 multiple, this would offer a tremendous rate of return going out for the next couple of years. It might be one that's worth looking at. Now, the stock hasn't been doing real well here the last couple of days, as you can see, although it is up just a smidgen today. But anyway, that's Autoliv. But anyway, these are the 4 companies that I skipped on the last video, and I hope you enjoyed this. I do think there are some investment opportunities here, but all of these stocks tend to be a little bit speculative. These aren't any necessarily blue chip stocks. These are companies that maybe are smaller in scale, smaller market caps, as we saw. Some of them have debt, but they're discretionary stocks. So you don't have to go eat it at Blooming Onion. You don't have to go buy sporting goods from Dick's. But if you want them, then those are places that people do shop at. So use your own discretion, do your own research and due diligence. If you enjoyed this video, give me a like, ring the bell so you get notifications for future videos, subscribe to the channel, and take a look at Fast Graphs. I think it's the value investor's best friend, at least in my opinion, especially how to use it correctly. Anyway, thanks for watching, and we'll talk to you again real soon.